Hey guys, it is Monday, June 17th, and Bitcoin's at 65.6. And this episode is called Wall Street is Skeptical. And there's an interesting article that came out. It was attributed to a BlackRock exec off the record saying, yeah, these RIAs are sort of in wait and see mode, and they're not committed to this ETF yet, and they're a little bit wary of putting their clients in a nascent asset like this. And I think that's right. I think that from my reading of the financial press, they are not jumping in to recommend their clients get aggressive exposure to Bitcoin. And by aggressive exposure, I mean 3 to 5%. They're not quite recommending that yet. And I think there's a bunch of reasons why. The first reason why is that from their perspective, Bitcoin is only a 5-month-old asset. This asset only started to really exist in January of 2024. It didn't exist in 2029, 2010, 2017. It only started really existing when BlackRock launched the IBIT ETF. And so this is a 5-month-old asset for them. It's not a 15-year asset. And a little bit in the same way when a VC invests in a startup, they view that their investment is sort of time zero for that startup. It's not, the startup may have been around for 3 years or 4 years, it doesn't matter. They sort of think, really, it's now that things start. And I think that that's just the way these professional investors think. Why are they wary? Well, I think that this asset is so different from other assets, right? Because let's take an asset like NVIDIA, right? Well, it's not a new company. It's a new growth story with AI, but it's not a new company. And you can model it from earnings, right? You can look at the earnings of NVIDIA. You can project what they will be next year, next 5 years, next 10 years. Same with Facebook, Meta, same with Google. So those assets, growth assets, there's a methodology for how do you evaluate them. On the other hand, you have these value assets, right? And which is kind of most of the S&P at this point, which you're just sort of looking at PEs and price to book value, and you're saying it's relatively cheap relative to historical earnings. So again, there's a model for that, right? And those are the kind of two big, ways of evaluating things, either growth or value. With growth kind of really having taken over the narrative over the last decade, really. Now, Bitcoin is not growth and it's not value. You can't really say, well, I expect the earnings to grow because there are no earnings. And it's not deep value because you can make the case that Bitcoin's cheap relative to gold, but that's not an argument that the average Wall Streeter is going to really understand, or really, they can understand it, but they're not going to really embrace that argument. So what are you left with? You're left with, it's a kind of a new type of digital gold. It's a new type of money that's going to take over. All that stuff is very out there for a regular Wall Street investor. I do think they're going to get there. And I think what's going to drive them there is just the price, right? Because we have the power law and we have the shortage of Bitcoin and people want Bitcoin. There's a need for Bitcoin. And I think it's going to be inevitable that we're going to get there. And I think at some point they just change their beliefs to fit the data, right? And I think that's what we're likely to have. But, in the interim, I think, I do think it's not going to be this complete tidal wave of RIA money or institutional money. It's going to be slow, right? So this 80% is going to be slower. I do think it's coming. I don't think it's necessarily coming as fast as some people would like it to come. And I'm very bullish nevertheless, but I do think this is going to happen without Wall Street just embracing this asset. So that's my episode for today.